Hey, this is Danielle. Welcome to my trade review video. I'm going to be talking about App today. This is a ticker that came up in our trading room yesterday. One of the traders asked me about it, went ahead and looked at it. Fundamentals look great, technicals look great, so I went ahead and made a bullish earnings trade. Now, if you look at the price action here, you can see that they reported earnings yesterday after market close. They're estimated to earn 57 cents a share. They made 67, and the price of the stock traded from about $74 all the way up to $86 overnight. Now, since then, the market has opened. It did initially bid up into $85.39, but it's already coming back down. Yes, the stock is still up 10% on the day, as you can see, which is $7.81. But I'm going to go ahead and get out of my trades right here, and I'm going to show you why. Looking at the earnings hot zone from yesterday, this is a screenshot that I took before I actually got into the trade. What you can see on this chart is that there was a very nice daily squeeze. There's also some pretty high implied volatility. The last 2 quarters, the stock experienced some very nice gaps, 16.7% up last time, 12.4% the quarter before that, and specifically last quarter it was a breakaway gap. We also had a pullback into the 50 simple, which is generally a pretty good buy the dip spot. And then I had a Fibonacci target at 82.46. Now, the 1272 extension is usually the first target that I'm going to use, but in this case, the stock has some high short interest. So I love trading stocks that have high short interest because what can happen is they can report earnings, it can be a little bit of a surprise, and then the stock can, be up 10%. So that's why I like to trade stocks that have a high short float that are specifically right near a previous high, because what can happen is when you have an outsized number of shares being held short, and in this case, it was 13.3%. And then the stock trades higher. Those short sellers are not going to be very happy. They're going to have to buy to cover. And then that causes upward pressure in the stock. Now, the thing about this ticker is that using the 1272 extension is a normal target, but when a ticker has short interest, generally you want to go a little bit higher. So that's why I was shooting for the stars with this one, thinking, if there was a big short squeeze, it could get up into 87 or $90 a share. But that's not the case right now. Right now it's at 81.75. So that's why I'm going to go ahead and flip my trades out. Generally, when you're trading a ticker that is a potential short squeeze candidate, what you want to see is you want to see that overnight gap up. And then you want to see it continue going, and you want it to break through the overnight high on high volume. You want to see a pattern of higher highs and higher lows. Basically, you want the candles to look like this right here, which is what it did look like overnight. But now that we're in the cash session, it's actually just trading lower, and it's trading lower on high volume. So while it's still up 10% right now, it can pretty easily give that back. So that's why I wanted to go ahead and close out of my trades. So when you're looking at my trades, what I have here, and it's come down quite a bit, even just in the last 20 minutes since I've been monitoring this. But essentially, I had a stacked trade set up. So I had a butterfly right here. This butterfly I got into for $1.35. It's currently trading for $2.50. So, not a huge winner. It was up about 2.5 times just a little bit earlier, but with that stock coming down like that, this butterfly is going to move really quickly. So, what I don't want to happen is I don't want the stock price to go below $80, because this butterfly was meant to be a shoot for the stars kind of butterfly. In case there was a big short squeeze, the target was at $90 a share. And right now you're trading just barely at 82. So you basically have a butterfly that's only, barely $2 in the money. And I'm basically lucky that it's making a little bit of money right now. So that's why I want to take it off, because I don't want it to lose money. Now, when you're looking at the other trade that I did in this case, I also did a put credit spread. So with this ticker, I did a put credit spread because we had some pretty high implied volatility. If you look at my screenshot from yesterday and we look at the earnings volatility, you can see here that this stock has a massive increase in implied volatility going into that earnings report. And last quarter, it just had this massive volatility crush. And so when I was looking at this stock, I thought, it would be cool if there was a big short squeeze and it traded all the way up to here. I could get a 10x on my butterfly. That would be fun. But, more likely, what would be the more conservative trade would just be simply to sell a put credit spread, because this is a ticker that I'm bullish on. Here, actually, let me show you a longer term view of the earnings hot zone. The reason why I was bullish the stock is because it's not just gapped up 2 quarters in a row. If you go back and, prior to yesterday, it had gapped up 6 quarters in a row. So that is phenomenal. That's a great pattern. You can also see that there's a bullish trend in the stock. You're up above all your moving averages. You had this nice squeeze. So this is a ticker that I look at and it's like, there's nothing else I can do except for be long. So when I'm looking at all of that, I did decide to do the out of the money butterfly, for kind of like a lotto trade, because with those flies, you can get like a 10x, if you're right. But the more likely and easier way to trade it and simply trade volatility crush overnight is just to sell a put credit spread. So when you look at my vertical right here, this is a put credit spread. So looking at this put credit spread, what I did was I sold the $74 puts and then I bought the 70 puts as protection. What this did was it gave me a credit of $1.85. So what I'm looking for with a put credit spread over an earnings report is I'm looking for the risk to reward, because what's more important than anything is what happens if you're wrong. You don't want to be selling naked puts where, you could potentially wake up and, app could be down 12% and you're getting completely crushed on a put that you sold. We don't want that. So instead, what I will always do is I will do a put credit spread if I am bullish a stock and I think it's going to trade higher. So basically, yesterday, app was trading at $74. So that's why I sold that $74 put. That was the at the money put. And then I just made it $4 wide because I was trying to get as close as I could to 1-to-1 risk to reward. When you have a $4 wide spread, trying to get a $2 credit would be ideal. I got $1.85, so that's pretty close. So I'm fine with that. Now, looking at this trade, you might say, well, why would you take it off? And, I've seen um, I've seen stocks like this come all the way back, and you don't want a put credit spread that was basically a max profit to end up losing money if the market shifts on you. So, sold that spread. You technically don't have to buy it back, because if you look at your options chain, it's so far out of the money, it could just expire worthless. But I'm gonna buy it back anyway. So there you go, back for $10. Oh, looks like they are actually charging me $6.32. I'm gonna have to check on that. Should be free if it's less than 5 cents. So a debit of $4.05 would be a 300% winner. So now that it's going for $4.17, that is up to a 300% winner. So as you can see, this is pretty volatile. It's changed quite a bit, just gone up by about $250 in the last, 3 or 4 minutes. Now that I'm going back and looking at the chart to kind of see what's going on here, okay, and I'm filled on the put credit spread, You can see that the stock is starting to shift higher. This is a 15-minute chart. Ideally, what you would see is this 15-minute squeeze fire to the long side, and maybe it would trade up into 87 or 90. That would be great. Um, but it's also just fine to take it off right here for this price, because, like I said, that's going to be 300%. So the butterfly is a 80, 90, 100 butterfly. The max that you can make would be up into the $90 strike. So there is still another $6 of upside, but like I say, try to be pretty conservative with these. Try to get in and out. Um, I think this one's just gonna have to be good. So let's see if I can get filled for 300%. And then that will be the end of this video. If you want to learn more, you can join me in the trading room at Simpler Central. There's a link down below. Um, you can also follow me on Twitter at Trader Danielle. Other than that, hope you have a great rest of your day. Let me know if you have any questions or video requests in the comments below, and I'll see if I can get those made for you. Talk to you later.